Why was counterparty risk a concern for early derivatives? Imagine making a deal that depends entirely on someone else doing what they promised, but you have no way to guarantee it. That was the challenge with early derivatives. These contracts were based on future events or assets, and their value could change over time. Unlike a simple loan with fixed payments, derivatives could fluctuate a lot, making it hard to know what might happen later. If the other person failed to deliver or pay, you could face big losses. This risk was especially high because most of these trades were done directly between two parties, without any middleman or safety net. Back then, there were no clearinghouses or standardized rules to help manage this risk. People simply relied on trust or their own agreements. If one party ran into financial trouble or decided not to honor the deal, the other was left holding the bag. This was a real concern because, without safeguards, the whole system could collapse if enough people defaulted. Early derivatives often involved long-term commitments, which increased the chance that something could go wrong over time. Looking back to ancient times, derivatives started as simple forward contracts in Mesopotamia, where farmers and merchants agreed on future sales. But even then, the risk of one side not fulfilling their part was clear. Fast forward to the 17th century, during the Dutch tulip mania, people traded contracts based on tulip bulb prices. When tulip prices crashed, many traders couldn't pay what they owed, showing how unregulated and risky these contracts could be. In the 1800s and early 1900s, trading was mostly over the counter, meaning deals were made directly between parties. There were no central organizations to guarantee trades or handle defaults. The introduction of clearinghouses in the late 1800s was a big step forward. These organizations would act as middlemen, netting transactions and making sure everyone honored their commitments. For example, the Consolidated Stock Exchange set up a clearinghouse in 1886, which helped reduce the risk of someone defaulting. Over time, new methods were developed to manage this risk. Parties started posting collateral or assets as security, so if someone defaulted, the other could recover losses. Bilateral netting agreements also helped by offsetting mutual obligations, reducing the total exposure. Eventually, the creation of central counterparties, or CCPs, became standard. These organizations guarantee trades and requiring members to keep enough assets to cover potential losses. All these changes came about because early derivatives were risky. The contracts' values could change unpredictably, and without a safety system, defaults could cause chaos. The evolution from simple agreements to complex safeguards helped build the stable financial systems we see today. This history shows how managing counterparty risk became a key part of developing reliable and efficient derivatives markets.